Thanks, Katja. So it's 8:01 in Vancouver on a beautiful morning this morning, and I'm very happy to be here. So I'd like to thank the organizers for putting this paper on the program in the fall. This is joint work with Chris Frei at the University of Alberta and Josh Mollner, who is with us this morning. So in case there are any tough questions, we might have to ask Josh to jump in. So for those of you who know me, I've started to get real interested in how institutions trade, and this project is kind of in that sort of vein, related on better understanding of how what the issues are that institutions face when they conduct large trades. And I think there's a really interesting set of issues to think about. So suppose you are a financial institution, let's say maybe a pension fund, and you're looking to buy a large position. So one thing you might do is to buy the position from a dealer. So in the morning of the trading day, before the market opens, you call up your dealer, and after talking, you agree to conduct a block trade. And that block trade will take place after the market closes. So to make things concrete, let's say you're interested in buying 1 million shares of Apple, and now you might ask, why will the trade take place after the market closes and not right away? Well, the dealer probably doesn't have 1 million shares of Apple lying around, so he needs to do what's called trading for the purposes of fulfillment. And in other words, he needs time to acquire those 1 million shares, and he needs to do that probably by buying it from the market. Okay. Now, another question you might ask is, why doesn't the pension fund just buy the shares it wants directly from the market? And there are many reasons we could give, but one is that trading on the market is a complex problem, so it would not be wise to send the market order for 1 million shares. Instead, you'd want to slice and dice that order, possibly sending it to many marketplaces in order to minimize price impact. But that's a complex problem. So what firms often do in practice is to outsource those complexities to a dealer in the way that I'm describing here. Now, there's one more remaining issue, and that has to do with how they agree to price the block trade. Okay, and some common arrangements are, usually this is a function of the prices that are realized on the market, and so they are not known at 8:30 in the morning, but they will be known at 4:30 p.m. And so common arrangements are or the closing price of the market, so that would be the 4 p.m. price, or the TWAP price, so the volume at a time-weighted average price throughout the day. So those are common contracts that we see in the wild. And the questions that we're interested in is, are these common arrangements optimal in some sense? And if they're not optimal, then a follow-up question is, how could we modify those contracts so that that we can improve outcomes? Okay. Now, to tie this a little bit closer to a formal model, we can think of this problem essentially as a problem of contracting on the moral hazard. So the pension fund, and more generally the client, plays the role of the principal, and we assume she's risk neutral, and that she moves first by choosing a contract tau. And the contract is simply a payment rule for pricing the block trade that they're going to do at the end of the day. Now, the dealer plays the role of the agent, and he's potentially risk averse, and the dealer sees the contract tau, and then he moves second by choosing a sequence of trades, of his hedging trades X. And then the payoffs are what you think they are, and the key friction again is hidden action, in a sense that the client cannot observe the trades by the dealer, which of course influence the price. And I think that's appropriate for the settings that we have in mind. In many cases, trading, for example, is anonymous, so the client can't verifiably observe how the dealer is trading. The client is only able to observe and contract on the market price is P, and there's going to be price impact, which means that the dealer's trades will influence the market price P, and we'll have to take that into account in the analysis. And what we do in the paper is to solve for the optimal contract, which turns out has some really nice structure to it, which we'll be able to analyze. All right, so of course there's a related.
Markus?
Yes, sure.
Sorry, can I just clarify, when you talk about the times, it's tau of P1 PT, so this is tau is the total price, and so it depends on the prices in the future. What kind of timing do you have in mind? Like how frequent are you?
All right, so we can think of the time period as 1 day. That's kind of a common one, but you could think of it as multi-day arrangements. Usually the time frames for those arrangements are not very long, so a day is probably a good starting point. And then tau is just a number, is the price of a. It's gonna be a weighted average of prices in the end, but in this general formulation, it's just the price that is allowed to be a function of those prices. All right, so let me talk a little bit about the literature. So at a very high level, what we're doing is connects to a long tradition of models that study contracting in financial settings. So we have papers that model delegated portfolio management, where the agent selects a financial portfolio. Then there's a literature on delegated asset management, so where the agent manages capital invested in a risky asset, and one concern in that literature is that he might secretly divert returns. So in this paper, the agent performs a different financial task, namely the scheduling of the execution of a large trade. And to the best of my knowledge, we don't have many models in that space. So I'd be curious to hear your views on this. So we view this project as a hole in the literature that we're trying to fill. Okay, but in the interest of time, maybe I should move on. So this is basically my introduction. So maybe if there are any sort of high-level questions, maybe we can get those out of the way. Otherwise, I'll jump right into the model description in more detail.
Sure, I'll have one if I'm allowed to speak.
Sure.
Yeah, thanks, Markus. Just a quick one. So can you motivate which fractions of institutional orders use this type of arrangements? Because I think many of them have access to order splitting algorithms directly through their brokers or standard algorithms like that. So then the alternative would be to use one of those off-the-shelf algorithms that would not have this contractual problem. So.
Right. There are other problems, but I agree. It's difficult to quantify this. So I don't have a number for you, but many financial institutions, many pension funds don't trade in-house, for example. Block trading, I mean, it's been in the news recently. I mean, it's a big market. I cannot quantify how big it is relative to all of institutional trading, but I mean, institutional trading costs in equities in the US are roughly 70 billion per year. So even a tiny share here, we're talking real money. So yeah. Are there any other questions? All right, well, in that case, let me jump into the model. So we have two strategic players. So the client needs to buy an amount of some security, which we normalize to 1 share, and she's risk neutral. And then we have the dealer who's potentially risk averse, and we can play with that, and we do later in the analysis. Now, where is that dealer risk aversion, which is parameterized by lambda here? Where's this risk aversion coming from? Well, we have the usual sources, but in addition, you can think of it as coming from regulations that make it costly for him to take on risk. So for example, by requiring him to hold an amount of capital that corresponds to his risk exposure. And in fact, we'll assume constant absolute risk aversion. And that's to make sure that his utility function plays nicely with, for tractability with normally distributed random variables that we'll have in the model. Okay. Now there's also going to be a market, but the market is non-strategic, and I'll show you precisely how we model the market on the next slide. So then, as I mentioned in the introduction, the client and the dealer are contracting about a block trade that they will do at time t+1, so after the market is closed, and then there'll be an off-market trade. But prior to that, the dealer the dealer conducts a sequence of trades on the market in periods 1 through cap t. And so in a sense, one way to think about this is that the dealer is intermediating between the client and the market. All right, so how do we model the market? Okay, now there's a price in period t, and that has a number of components. So it is the initial price P0 plus gamma times the amount that the dealer trades in time t. So you can think of gamma as the coefficient of temporary price impact, and then we have theta times the cumulative amount that the dealer has traded so far. So you can think of theta as the coefficient of permanent price impact. So we'll allow for both temporary and permanent. And then there's the sum of all the price shocks that we've had so far. And these price shocks are all assumed to be normally distributed. So if the dealer didn't trade at all, so if all the x's were 0, then the price would simply evolve as a random walk. But the dealer's trading can push prices away from that. Okay, so this is a pretty canonical way of modeling price dynamics, and it's been used kind of widely in the literature. And then the next thing I have to tell you is about trading strategies. So what is a trading strategy? Well, when the dealer chooses X1, he knows nothing, only the parameters of the model, of course, and what the contract was. But when he chooses X2, he also knows what P1 was, what the price in the first period was, and he chooses X3 with knowledge of the previous 2 prices, P1 and P2, and so on. But whatever he does, he has to satisfy this constraint in red, which says that the amount he buys from the market must equal the 1 share that he's going to sell to the client later on. Okay. Now, so here's the problem that the client needs to solve. Now, the client needs to choose a contract tau and the recommended trading strategy X with the objective of minimizing her expected payment. So that's the payment is tau as a function of P. Subject to 2 constraints, to an IR and an IC constraint. And these constraints say what you think they say. So, but just to make sure we're on the same page, let's look at the IR constraint. So focus on the left-hand side. Focus on the left-hand side. So tau is the dealer's revenue, and what he gets, what he gets when he sells to the client. X dot P are the dealer's costs, what he pays to buy from the market. And X is a vector that says how much he buys in each period, and P is a vector that says what the price in each period is. So his trading costs are that dot product. Okay. Now his profit is the difference between the two, and then we pass this through his utility function, and we say an expectation, his expected utility must be at least U of 0, which is the outside option of not engaging with the client at all. And the IC constraint is analogous. So this is a model, again, a model of hidden action. So the client can't directly see what exactly the dealer trades are, and if he followed through on the, in particular, and if whether he followed through on the recommended trading policy. So instead, the contract has to make sure that the policy is incentive compatible. Okay, now finally, I have to tell you what the set of contracts are that we're allowing. So this is this calligraphy tau T, I guess. So I've already told you that we're looking at contracts that are functions of prices, of market prices. But within that, for tractability and for realism, we restrict attention to contracts that are weighted averages of those prices. So from this point on, we can think of a contract as a t-dimensional vector whose components sum to 1, and where the payment is simply the dot product of that vector with the vector of market prices. Now, in the introduction, I alluded to two contracts that we see in the wild. They both are nested in this formulation or this contract. This formulation nests both of those special cases. So the TWAP contract would be one with constant weights 1 over T. And the market on close contract would have 0 weights in every period except the last.
Sir, can I ask
yes.
again?
Sure.
So for the periods, like how often the dealer trades is that that's not a choice variable, right? That's preset in the model, and is it generally in practice anybody's choice variable, or how does it?
So are you asking what a time period is in the model? Is that?
Yeah, sort of, because you're accumulating it over the day, but how are you trading throughout the day, and does it depend? I mean, here you have the one share that I have to acquire, but does it matter like at which frequency I have my trades?
So just to be clear, so the one share, the quantity, and that is fixed, okay? And I think that's pretty realistic. Yeah. You know, the client wants to buy a certain quantity. The time periods are also, capital tau is fixed, although we will take the limit in the end, and we're going to end up in a continuous framework. So that is a part of the institutional setting.
Yeah, I think that's
whether
what
he
I was
trades or not.
The capital tau, how many capital tau periods?
So for now, it's any number you like, and then later on, I'm gonna let that go off to infinity. But just to be clear, it doesn't mean that the dealer has to trade at every period. This is how many times he's allowed to trade, how often sort of the market clears. The dealer could choose not to trade for half a day and then do everything in the afternoon. But we're not restricting how often the dealer trades. Does that make sense?
Yeah, I think that answers it. There is also a question in the chat from Jim Angle.
Okay.
Since I paused you anyway, sorry.
So what's the question?
Oh, so Jim, I don't know if you want to ask your question in voice.
Oh, I'm still trying to get my brain around the model. And it looks to me that since you've got, with the market impact function you have, I would think market on close would dominate, since the market impact is the same and there's no risk to the dealer along the way. So what am I missing here?
Right. Okay. So you are right that a contract that loads toward the final period, it turns out the optimal contract has a flavor of there's going to be an atom at the end. What are you missing here? First of all, there are many ways to trade so that the dealer does not bear any risk, and I'll make this more concrete in a couple of slides. In general, with permanent price impacts, the dealer is going to have a front-loading motive, and so the optimal contract will have to account for that. And part of how it's accounted is that there's going to be some weight at the end. A market on close contract, in general, it does not dominate other contracts. So in general, it's a bad contract. But the optimal contract will have features of a market on close contract. But maybe it makes more sense once I have some slides on where I try to kind of tell you about the intuitions, and maybe we can wait a little bit. I don't want to foreshadow too much, because I think I might add more confusion than clarification at this point. So let me first show you the first best problems as a benchmark. Okay, so the first best version of this problem is one that minimizes the expected cost of buying one share. Okay, and what makes this slightly non-trivial is the fact that prices are endogenous to the trading strategy itself. So X changes P also. And this is a problem that has received kind of relatively a fair amount of attention in the optimal execution literature that solves exactly problems like that. And in fact, because our price dynamics are so canonical, this is exactly the baseline of a couple of these famous papers in that literature. And when you solve the problem, it turns out to have a really simple solution. In fact, it's optimal to smooth out your trading and trade at a constant rate, 1/t, so you're buying an equal amount in every period. Okay, so that's the best you can do if you were to schedule the trades yourself. Okay, now let's talk about, so with that knowledge, what would happen if the client could contract without worrying about the incentive compatibility constraint? Okay, then she would just tell the dealer to pursue the first best trading strategy that we just derived. Okay, and then she would pay the client according to the time-weighted average price. Okay, now why is this what she would want to do? Well, the short answer is because she can't do any better. Okay, so it's the efficient action, which I've shown you on the previous slide, 1/t in every period is the first best. And on top of that, it's also efficient risk sharing. And why is that? Well, because the dealer's revenue, tau.p, is the same as the dealer's cost. And they offset state by state. So this contract perfectly ensures the dealer. So this is, I guess, a partial answer to Jim's point. So this contract perfectly ensures the dealer state by state. So regardless of what the epsilon shocks are. And so this means we have efficient risk sharing. Remember, the client is risk neutral. So it's efficient to perfectly ensure the dealer who's allowed to be risk averse. And plus the IR constraint binds. So in other words, one way to think about this is we've made the pie as big as possible, and we're giving all of that pie to the client, and nothing can do better than that. So this is what the client would do without an IC constraint. Okay. Now the question is, can you do that with the IC constraint? And the answer is generally not. Okay. Now suppose the dealer deviates from this recommendation by choosing a trading schedule that's front-loaded, meaning there's going to be a higher weight than 1/t, let's say in the first period, and then a correspondingly lower weight later on. Okay. So what happens is that the dealer's revenue remains an equally weighted average of the prices, but his costs are now more heavily loaded on the earlier prices. Okay. Now, because we have permanent price impact, the early prices are lower in expectation. Now, why is that? Well, if I trade in the first period, I push up the price in the first period, but also all subsequent periods, prices 2, 3, and 4, and so on. Okay, so what that means is his expected revenue is now greater than his expected costs. So he's earning an expected profit. But hang on, you might say, now there's also price risk, because that does not perfectly insure him anymore, state by state. And that's true. But it turns out that that there's a first order increase in the expected profits and only a second order increase in the variance. So what that means is, for an arbitrary degree of risk aversion, a small amount of front loading is always optimal. Okay. So now the question is, well, what happens but what will the client do when she has to worry about the IC constraint? And that's essentially the rest of the paper. Those are our main results. So let me sketch out the client's problem and how we solve it. Okay. So the first observation is that we can actually eliminate the IR constraint altogether. Well, why is that? Well, for any average weighted average price contract tau, the dealer can always select a trading strategy with the weights that exactly mirror the contract weights. And so if he does that, his revenues and his costs are equal state by state, so he can always guarantee himself 0 profits. Now, of course, he might be able to do a lot better than that, but the worst that can happen is he can always lock in a profit of 0. Okay. Now let's tackle the IC constraint. So it turns out that we can characterize this as a product of matrices, which is so those matrices are kind of cumbersome, some might say ugly. So don't pay attention to their specific form. But what I want to talk about is that the dealer's best response is a static trading strategy, in a sense that it's just one vector, which you can think of as being chosen at time 0. So now, even though he can dynamically condition his trades on previously observed prices, it turns out it's not optimal to do that. So let me give you some intuition for this. So after implementing X1, the dealer observes P1, right, which immediately reveals the realized epsilon 1. Now the question is, should he re-optimize? He has just learned something about the price process, and the answer surprisingly is no. And the reason is that his revenue and his costs are both weighted averages of prices, and epsilon 1 shifts every price, so it cancels out. So it doesn't affect his profit, so learning it is irrelevant. Okay, so now more generally, after implementing XT, he observes the corresponding PT, which reveals the realized epsilon T, the price shock in that period. Again, will he re-optimize? The answer is no. So he has carry utility, and epsilon T shifts his profit by a constant. So that doesn't affect his preference. Therefore, learning it doesn't affect learning is irrelevant. Okay. Now, finally, let's use this to characterize the optimal contract. So we've killed the IR constraint, and we've rewritten the IC constraint. So this is now the client's problem. So we've simplified that quite a bit. So let's plug in that constraint, and it turns out that the client's costs can be written in this quadratic form. So now it's just a function of this somewhat cumbersome matrix M, but it's a quadratic problem, and we obtain this really nice closed form solution, which is essentially the inverse of that matrix M multiplied by a column of ones, and then there's the scaling factor, making sure that the weights sum to 1. So we get this surprisingly simple solution. All right. Now, so this is basically, in conclusion, sort of the result that we have in the paper, just to show that the optimal contract is tau star, and so this is what I had on the previous slide. And then it turns out if we plug that into the dealer's best response, we get X star, which is I mean, so there are a couple of takeaways. So this result tells you that you can actually solve this model, which is nice. It has a pretty simple solution, but it doesn't really tell us very much about the economics of the solution. Okay, so I hope I've convinced you that it can be solved, but I haven't really told you any insights about it. And it turns out we can do a number of things to pull out some intuition about these formulas. And that's what I want to do for the remainder of today. So there are, let me give you a bit of an outline of what we do in the paper, in case I don't get to everything I want to cover. So on the next few slides, so what I want to do is I want to tell you about limiting cases, and with 3 of them in mind. The first one is if we shut down, basically we shut down temporary price impact and risk aversion, and so then permanent price impact will become the dominant consideration. It turns out that's an interesting case to look at. And then we do the same for temporary price impact, where you shut down the other 2 and consider temporary price impact as the dominant consideration. And then we do the same with risk aversion. Okay, and the idea here is by simplifying it in that way, it gives us something that's easier to look at and easier to interpret. Okay. Another way, another approach that we take to understand the general solution better is to plug in some parameters and compute the contract and the trading strategies and do this kind of numerical analysis. And that suggests to us, or that shows us, that there's some really interesting structure in those contracts, which I'll tell you about. Now, what we're most interested in is the continuous time limit of this discrete time model that I've alluded earlier in response to Katja's question. I mean, after all, what is a time period in the trading period in the first place? I think that came through in the earlier questions. And if anything, given trends toward faster and faster trading, the continuous time limit might well be the right version of this model. It turns out, from sort of a theoretic perspective, that the complicated structure of the discrete version actually kind of goes away in the limit, and we actually obtain a really clean result in that limiting case. So I hope I'll have enough time to show you that. So okay, so let me show you some numerical analysis. So what we do here is we vary the amount of permanent price impact. So that's, remember, that's theta in the model. A low number of theta means, so theta equals 0 is no permanent price impact, and then we dial it up all the way to 1. On the left panel, we have the optimal contract weights, and on the right panel, I'm showing you the trading strategy. Okay. Now let's look at the contracts first. So as you can see, these weights are symmetric. The first weight is always equal to the last one, and the second one equal to the penultimate one, and so on. And we proved that this holds in general. And at some level, I think this is intuitive because price impact is linear in this model, and this is a quadratic problem. And quadratic problems often have solutions that feature a lot of symmetry. Now, you can also see that those contracts are U-shaped, and I'll give you some intuition for that later when I'll tell you about the continuous time limit. So on the right, we have the trading strategies that correspond to the optimal contract. And now one extreme case is the green line. So that's the case of no permanent price impact. Now look, in that case, both the optimal contract and the trading strategy are, first of all, identical, and they are constant. So with so this is the 1/t result, and so the outcome is exactly what we said the client would do if she didn't have to worry about the IC constraint. Now, why is that? Well, remember we said that the problem with the IC constraint is that because of the permanent price impact, this creates an incentive to front load the trading, precisely because earlier trades kind of push up later prices as well as the current period price. But in the case of theta equals 0, that's the case where there is no permanent price impact. So that shuts down that channel, and therefore we get this limiting result, or this symmetric result. And in general, for any theta that's non-zero, we can see the front loading motive here, that the client loads more heavily on earlier periods and less so on later ones. Jim, did that sort of answer your question a little bit?
Yes.
Great. So let me tell you a little bit about the continuous time limit. So so here's the formal results that we have in the paper, and let me walk you through it. So for technical reasons, first of all, we assume in this part of the paper that the dealer is strictly risk averse. So we have some lambda greater than 0. The reason why we require that, it keeps the convergence results well behaved. Okay. Now, second, the way to think about this limit is we take a sequence of models, which we index by k, where we send the number of periods to infinity. But at the same time, we shrink the size of each period so that the aggregate risk, the aggregate price risk, remains constant. So what we do is we take the day and we just chop it into smaller and smaller increments. Okay. Now, and the best, well, maybe I shouldn't say the best, but then this results describes the limiting optimal contract and the limiting dealer best response in terms of their CDFs up through quantiles Q, where we solve from 0 to Q, set Q equal to 0 all the way up to 1. Okay. But I think instead of working through the math here, I'll show you the PDF analogs, and I'll illustrate that graphically. So again, this is similar to what I've shown you before. On the left panel, we have the optimal contract weights now in the limit, and on the right, I'm showing you the corresponding trading strategy of that limit. Okay. Now both of those entail a constant density at interior times, so that, as indicated by the line here, but as 2 lines, and atoms indicated by those boxes at the endpoints, the first and the last period. Okay. Now, for the optimal contract, the density is at a height of A, and A is it was hidden down here at the bottom left. It's a fairly simple expression, a simple function of the parameters. Okay, and it turns out for the optimal contract, those 2 atoms are symmetric, are of equal size. Now for the dealer's best response function, so the trading strategy, the density is also at a height A, and the atoms now have different sizes. So we see the front loading motive. So in particular, the initial atom is 3 times greater than the final one. Okay. Now, now we were surprised to see how simple and how, well, dare I say, beautiful things are in that continuous limit. So everything is pinned down by the single value A, and we can also talk about some comparative statics of this result. For example, as the permanent price impact, so that's theta, increases, A decreases, and we get a more severe U shape for the contract, and a more severe front loading for the dealer's trading. And that's exactly what we saw before in the numerical analysis in the picture I showed you for the discrete time case. And this is the continuous time analog. And now, and similarly, as the dealer's risk aversion, so that's lambda, increases, A increases, and we get a less severe U shape and less severe front loading. Now, let me give you some intuition for the shape of the optimal contract. so in particular, what drives the initial atom and what drives the terminal atom. Now, first, let's talk about the initial atom. So now the client's payment is tau.p, okay? Of course, the contract tau influences the dealer's trading strategy, which influences the evolution of prices, but let's just consider the direct effect. Think about what the client would do if prices would not respond to the contract, okay? Now then, clearly she would put all of the weight on the period with the lowest expected price, and because of permanent price impact, this is gonna be the initial periods that have the lowest expected price. So that's my story for the initial atom, okay? Now and what about the terminal atom? Well, we have to think about how the contract influences the dealer's trading strategy. It's efficient for the dealer to trade smoothly, okay? Why is that? Well, we saw that when we solved for the first best benchmark. That's what you'd want to do to minimize trading costs. Well, how can we get the dealer to trade smoothly? Well, I've previously argued that the dealer has a front-loading motive. And so to get him to trade smoothly, the client needs to add weight on the late periods to undo that or to induce him to smooth out trading. So that's why I said in response to Jim's question, the optimal contract in the limit is not a market on close contract, but because of that terminal atom, it has a feature where the last period price actually turns out to be really important. So maybe let me conclude. So we've solved for the optimal contract in a setting where the client contracts to trade with a dealer, understanding that his pre-hedging trades will have an impact on the market prices. And we model the market in a pretty canonical way. So we make exactly the same assumptions that have been used in parts of the optimal execution literature. And in fact, the first best version of our problem is exactly a version of those classical problems that have been solved. So you can think of what we're doing as studying how things change once we introduce an agency friction. Okay, and one reason to care is that our results could help reduce the transaction costs of institutional investors, pension funds, etc., by suggesting ways to modify common arrangements. For example, one of those common arrangements involves setting a payment equal to the time-weighted average price. And that kind of resembles our optimal contract, which also weights interior times at a constant density. But our results suggest that it might be better to shift some of that mass to discrete weights on the open and on the closing prices. And likewise for market on close contracts, as I said, that also resembles our contract in a sense that we have that atom at the closing price, but our results suggest that it might be better to shift some of that weight earlier to earlier prices. And as I mentioned earlier, I mean, in the paper we do a little bit of a back of the envelope calculation that suggests that moving from one of those suboptimal contracts to the optimal contracts suggests that those gains could be in the billions per year for the US alone. So I think maybe I'll stop here so we have some time for questions, or would you like me to keep going, Katja?
No time for questions.
I'm all warmed up now.
And there are a couple in the chat, I think from Peter Lerner. I'm not sure, Peter, did you want to unmute yourself and just ask this in voice? Should I read it?
These are passing thoughts. They are not really questions. Maybe.
So what's the thought?
First thought was that this model could be applicable to slow trading mutual funds as well, but they abhor front loading, and the unit trust model of constant allocation is out of fashion for many decades. This was the first passing thought. Second passing thought was that if client wants to sell, then price impact can be, permanent price impact can be negative. And I'm not I looked at your formula for A and thought that maybe with negative theta, the formula can look ugly.
Wait, so the price impact will be negative because X will be negative, right? Just to be clear. The price impact will be linear and you're just applying a negative. So theta is always positive, right? Negative theta would be a weird, negative theta would mean I'm buying and prices fall.
Okay, then
so I think
yes, that's why I put it in chat, because I didn't want to.
No, I think that's so. Confusion. I don't. Right. So so I don't know. So the second point, I think that's just a clarification. So theta stays positive, but then of course, if you're selling, everything is symmetric and gets flipped. Of course, the prices will not move up, but the prices will move down. But other than that, the optimal contract is not affected by that. About the mutual funds, I don't have a good answer for you right now. I want to think about this some more. I don't know, Josh, do you have any thoughts that come to mind?
I'm sorry, I didn't fully understand the question, Peter. Are you kind of thinking of the mutual fund in the role of the client in our model, or the mutual fund in the role of the dealer in our model? Sorry, I think you're muted still.
I viewed mutual fund as both client, as both dealer and like manager, because they can be lumped together in this context.
I see. So I guess maybe my co-authors and I'll have to huddle up on this, but the way we would think about this is that this model kind of applies when you have an agency problem, when the principal and the agent are separate, or in our case, when the client and the dealer are kind of separate entities, and there has to be some contractual arrangement to resolve the agency frictions there. So if everything is happening in-house, I don't know if this is exactly the right model to think about that.
Right.
Jim.
I'm wondering what happens when the institution's trader is actually judged according to different benchmarks. So that, for example, if they're judged according to VWAP, how would that actually change the analysis?
Right. So let me start by a different benchmark, implementation shortfall. That's the one we have in the paper. So that would be the cost minimization way. So that we're okay with that. VWAP. So we don't have volumes in this paper. So in some sense, every period is equally weighted, and that's why we get the TWAP contract to be optimal. So if we say volume is just a flat line, so it's equally it's uniformly distributed over the course of the day, then we would get VWAP as well. But I don't know how much I would lean on that, because we don't really have a serious model of volumes. Now in our earlier paper, there we took volumes more seriously, but then we had sort of we were pretty light on the price dynamics, so we only had temporary price impact in that other, whereas here we have much richer price dynamics. So we don't have much to say about volumes. I don't know, Josh, do you want to add to that?
Yeah. So Jim, was the question, what would happen if we changed the client's objective. So currently what the client is trying to do is to minimize, implementation shortfall or minimize, how much she's paying for the position. And then you're thinking about a different model where what the client is trying to do is to minimize the difference between that payment and VWAP. Yeah, I think that's a good question. I don't know what the answer would be. As Markus pointed out, we can't literally define VWAP. We could kind of, say the difference between that and TWAP. So this could get us close to the spirit of your question, but I don't know the answer. Sorry, go ahead.
Because I think you've got a really cool paper here and a really cool result, and a nice extension to it, or perhaps a follow-on paper. You could make the volume in the market a stochastic random variable, which would be a little bit more realistic because you never really know what's going to happen. And it would be just really fascinating to see what kind of results you get there.
That will keep us busy, Jim. But I agree, it'd be interesting.
So I have somewhat and related follow-up. I mean, the market on close and VWAP, TWAP is a fairly, it's kind of an easy benchmark to think about. And here you're saying you have an atom at the beginning and an atom at the end, and there are particular formulas for how you compute them. What happens if you get them slightly wrong or something goes like, is it still better than the standard benchmark, or is it like how robust is it to the potential mistakes in practice?
So you mean, is this about parameter uncertainty? Are you worried that we might not know what theta and what gamma is?
Well, you don't really know what happens in the market. Like if the volume came and it's just something like, so you don't have it in the model, but in practice, volume is, you can't quite control everything. So suppose I believe the paper and I say that, I'd like to change the contract so that you have some atomic weights at the beginning and at the end. And
right. So two things would happen here.
This, but since I don't know all the parameters in practice, how do I implement this? Do I just shift my how?
So the parameter that matters is this A, right? The question is how easy it is to determine what A is, right? So you do need to have a notion of what the permanent component is, the temporary component is, what the variance of prices is. So this is something. So the question is how easy would it be to estimate this?
Yeah,
I think you have to be a little.
If I got it wrong, am I still better off with your approach, or am I better off with just the standard market on close or something like this? I guess that's my question.
So we have to be mindful that Chris is not on this call because he has work on, the math becomes very complicated when you're learning about the market conditions as you're trading. So that's a hard problem, as you can imagine. So I can tell you what happens for optimal execution algorithms as so you start with a prior on what the weight should be in every period. And then as the period happens, you learn about what kind of day it is. And that factors into your optimal execution algorithm. So you're kind of solving two problems at the same time. Now adding on top, so that I think it would depend, and so I haven't thought this through very carefully, so I might be off here, but the first best is not affected by any of this, right? Even if, okay, now you might say volumes are not even in the model, so if you add something about volumes, then I don't have anything to say. But let's say volume is what it is, and the first best result is not affected by knowledge of the parameters, but the contract would be. So I think we could investigate what would happen if there's an error. If A were measured with error, what are the outcomes? Well, I suppose it depends on whether the dealer knows that it's wrong or not. I'm sorry, this is like a stream of consciousness. I have never thought about this problem. It's a very interesting question. I don't know if Josh has anything meaningful to say. I think it's worth thinking more carefully about it, which I haven't done prior to just now. Josh, do you have anything?
Yeah, I mean, as Markus said, we don't have a formal result about this. my sense is that, you know, as long as you get kind of reasonably close, you're still going to be able to do better than kind of one of these other benchmarks. But kind of what you know, how close you need to be is not something we have a formal result about. So this is, I guess, conjecture.
Yeah, thanks.
It's
No,
good
I wasn't
suggestion.
asking for a formal result. I was just wondering if you had a sense for, if you're a little bit off, are you still better off with like not the simplest possible standard, and what other? Yeah, thanks. Any other questions or comments or passing thoughts? Going once? No. Okay, well, thank you very much, Markus. Very interesting paper. Thank you, Josh. Thank you all for joining us and for comments. And we hope to see you all in 2 weeks when we'll have Dermot Murphy talking to us about retail order flow. And I should know the exact title of the paper, Competition for Retail Order Flow and Market Quality. So thank you once again, and see you all in 2 weeks. Bye.
Thank you.